Everybody, Michael Finch here with SVN SFR Hub Advisors, and welcome to Pieces of the Puzzle. We are going to be discussing today the Fed rate hikes and what its implications and impact have been on the SFR and BFR market. And we are welcomed with an esteemed panel today. We've got Will Frank with John Burns Real Estate Consulting, Jeff Pintar with Pintar Investments, and Beth O'Brien with Encore, a new financing company in the BFR space. We're going to start today with about a 10-minute presentation from Will, give an overview on the market and following that, panelists, and then open it up at the end for a Q&A with some of the attendees. So Will, feel free to share the screen and from here.
Okay, I will. Give me just 1 second here. Set up for a second. All right, everyone see that good? Or Jeff, can you give me just a thumbs up? Yep, perfect. Okay. I'll jump right into it here. I work with John Burns Real Estate Consulting. We are a national research and consulting firm. We work across the country in all major markets, secondary markets, tertiary markets. So we're digging into all the data. Hyper focused on residential real estate for sale and for rent. And what I'm going to do, we're kind of at a good point here for kind of a mid-year update, in the middle of the year. So I'll tell you where we've been and kind of where I see us going a little bit as far as our company stance on it. So the SFR, BFR, and the economy remain resilient. We've seen, obviously, interest rates tick up enormously, cooling year-over-year rent growth, but not falling SFR rents. And we're going to reaffirm our position that we came out with last month. We expect this year to be a normalized market for the industry, not falling or stalling. And then the pace of national SFR rent growth on new leases has slowed from about 5.5 in January to 4.7 currently. That's still at its historically normal rate, so healthy still. And then some of the attributing factors here. Job growth remains healthy. We've seen positive job reports. Inflation is cooling. Inflation typically hits those renters the hardest, their confidence as well as their pocketbook, but it is cooling. So those rate hikes that the feds are pushing are helping with inflation. And then very low supply, both on the for sale and the for rent market. This is preventing substantial declines in pricing. And then homeowners are staying put longer. We used to have an old rule of thumb that was about 7 years, everybody would sell and move. And we're seeing that climb to 10 years. That's also limiting supply. And then as we all know, mortgage rates remain high and prices remain high. I'm going to dig into two of those just a little bit more. Poor affordability and lack of inventory. Those are two huge drivers right now. So poor affordability in the for sale market definitely benefits rentals. Affordability remains a challenge. Mortgage rates, we're up at 6.9 above the 6.7 that I have here. And then this keeps many homeowners in rentals longer, or just forces them to become stay renters. Low for sale inventory is keeping homeowners out of reach. Nationally, there's about half as many listings as there was in 2020. 1.3 months of supply. So we measure this on supply of months. Normal is about 4 to 5, average is 4.4, so extremely low supply in the resale market. And then the cost of owning versus renting an apartment should narrow in the future going forward, but we just haven't seen it. That gap remains huge. I mean, last year, and the year before, we had skyrocketing home prices, then we had interest rates rising, and there's about a 60% gap right now. To put that into perspective, if you had an entry-level home that you wanted to buy, it's usually about $1,000 cheaper to rent than to buy. So really keeping people and enticing them to stay renters. Renter household creation accelerated. So at the end of last year, fourth quarter, we saw the market kind of turn with household creation for renters. We think there's about 81,000 new renter households in the market in the fourth quarter last year. That's giving more tailwind. That's also pushing to say we need more supply in new apartments, and also helping out the SFR industry. Just to highlight a little bit, I like it in a graph form because I think it really shows what's happening with listings. This is the time of the year where listings usually start cranking up. They start getting higher. Listings in late June, for some perspective, 2017, pre-COVID years, 430,000, 418, or in 2018, 420, 2019, 450. So this is where we typically see a normal market. And then in 2023, we're sitting down here at 245,000. That means listings are extremely tight. The challenge there for SFR operators is expansion. Makes it challenging to buy homes if they're not out there and available to buy, but that is propping up home prices. And the other thing we're noticing that's always a challenge right now is we lived with low mortgage rates for so long that the average person that has a mortgage is at 3.5%. It's difficult to entice that person to move when they're going to take on a 7% rate, let's say around 7%. So a lot of people are handcuffed to their current house. I'll dig in just a little bit to SFR specifically, do BTR after this. The single family rental comes off of recent highs. I mean, we saw some huge rent growth over the last couple of years. And then we expect single family rent to outperform both price and apartment growth. This typically happens in recessions. We're not in a recession, but we're in a difficult economy right now. And then I'll share our forecast with you for the next couple of years. Just, we don't expect negative for the SFR, but what we do is moderating down to 3%. That's a little bit lower than historical norms, but still strong. And then 3.5 or 3.5 for 2024 and 4% for 2025. Just to show a little bit about that, like I said, I always like these graph forms because you can see the highs and lows. If you look specifically at the 2020, 2021, 2022, we came off of tremendous highs, well above the average and some of the highest we've seen in 20 plus years. Usually we go through cycles where that's going to dip down quite a bit, and we're just not seeing it. So we're still expecting some strong forecasts out here for the next couple of years. And then the map that kind of backs up our forecast, I think it's great to show it across the markets. There's a lot of green here, a lot of really strong green. There's a few yellows. Yellows is still positive, but those are, the more challenged markets. Maybe a little bit more supply has come on, or other challenges in those markets. But the green, pretty much across the board in these smile states. This is 99 markets that we make up here.
Incredible.
Yeah. And then it is incredible at this point in interest rates. I mean, I think a year ago we weren't all expecting this. And then the BTR market. The reason I'm breaking this up a little bit, and I'll combine this a little bit with the apartment market, is the BTR space reacts much more similar to the apartment space. And the reason that is they're both very sophisticated owners and operators and managers. So the SFR is a little bit different. We still have a ton of mom and pops out there. I mean, it's dominated still with mom and pop operators that don't always push rents or don't really push people, I would say, to a higher level. Some of them just keep rents for the same for years. Nationally, rent growth has slowed. I mean, I just showed you the slide. It came off of torrid paces of rent growth. I mean, extremely high. BTR now growing at 2.5, more slowly than apartments and SFR, but still positive. and supply has been catching up with demand. So apartment occupancy has decelerated. Now it's come off of some of the peaks and highs. I mean, nationally and per market, we were seeing markets in 97, some at 100. It was unsustainable, I would say. And then it's dipping down to more normal levels, and primarily due to supply being added to the market. And then the BTR market, with a lot of new supply, has softened, especially in some specific markets. I have Houston, Riverside, and Phoenix highlighted here. But there's a little bit of softening in some markets. And then construction did surge. So that just speaks to that supply a little bit more. And then BTR developers, I think this is really interesting because we didn't see this at all 5 years ago. The BTR market has become a competitor for the for sale builders. We knew that over a couple of years, but it's really become a space where BTR is competing heavily for those lots. And then we expect BTR and apartment supply to pull back off of very high levels. I'm going to kind of run through a couple of these really fast because I know we're running out of time.
Yeah, I was going to say, Will, if you want to take it to 10:15 because we got it started a couple minutes late. So you got like 2 more minutes.
Sure, you got it. So then we expect apartment rent growth nationally slightly negative. And what I will say with that is we're always reassessing our forecast, and we're in the midst of that again. So our forecast may change slightly, but right now we have a slight negative this year. And that kind of coincides with the economy, high supply of new rentals, but also we have a lot of, I would say, mild forecasts for lowering rents, and that's mainly due to people's, sorry, just blanked here for a second, people's incomes going up a little bit. And then we do this by market. We still rate a lot of markets strong, which is surprising in this economy. And then some markets is slow. And it's just, I know we highlight this all the time, but each market does react a little bit different, but we're all dealing with the interest rate across every market. So that does not change. And then I wanted to highlight here just how the SFR apartment market and BTR track historically. Really from rent growth, this kind of highlights how apartment rent and BTR track, very similar. And then that SFR market is a little bit more steady because we have such a huge supply of mom and pop owners. And then occupancy rate. The one that I'd really point out here is look at the BTR, the blue line. I mean, and then look historically back at 18, 19, normal markets back then. We're still sitting above that on occupancy rates. Very strong occupancy here. And then last thing I just wanted to point out is we're doing some great stuff on migration. We won't dive into the migration, but we've recently got some great data. So we're trying to add that information into everything we look at in our forecast. But migration data is really interesting in the United States right now. Just people moving to new markets, moving out of markets that used to be hot. Something just to dig into for everybody out there is look at those new markets and look at the markets that might be shrinking. And we're doing some really cool stuff on the mapping on that. And I'll leave it at that. Thank you.
Yeah, Will, thank you. And before we jump into the some further discussion here on this, now that everybody is acquainted with Will Frank and John Burns Real Estate Consulting, I'd like to have Beth and Jeff introduce themselves and their companies as well, and then we'll kick off some questions and start some good discussion here. Beth, would you like to go first?
Want me to jump in? I'll go first. Thanks for having me, Michael. It's great to be part of the panel with Beth and Will. My name is Jeff Pintar. I'm the CEO and founder of Pintar Investment Company and a vertically integrated affiliated firms, vertical real estate and Port Street Construction, based in Southern California, and we've been investing nationally in a variety of forms of residential since 2009. we predominantly focused our investment activities in the scattered site SFR. And more recently, I'd say the last 4 or 5 years, we've also added on multifamily and build-to-rent communities, which we're doing in about 20 different markets around the country.
Hi, I'm
Thank
Beth
you, Jeff.
O'Brien. Yeah, thanks, Jeff. Hi, I'm Beth O'Brien, and I've been running a variety of private lenders in this space. And recently started Encore Finance. We finance the build-to-rent space, the scattered site SFR space, and really think of ourselves as kind of life cycle lenders to investors, starting with early stage bridge loans and construction loans all the way through stabilized assets.
Thank you, Beth. And for those of you that don't know me, my name is Michael Finch. I'm the principal founder of our SFR Hub companies. We have a national brokerage, 100% focus on single-family portfolios and build-for-rent opportunities, as well as a tech company, SFRHub.com, that does data research and valuation work. We do a lot of third-party feasibility studies in the build-for-rent space, not like a John Burns or a Hunter Housing, but it's really more from the ground up and optimizing the product and the homes and the unit mix, finish levels, exterior building systems, et cetera. And our third company is an investment company, SBN SFR Capital Management, that's also acquiring build-for-rent communities around the country. So all that said, Jeff, I'll kick it off with you because I think you have, from an operator's perspective, I'd like to get your thoughts on how the Fed rate hikes have affected you guys and the housing market in general as you perceive it.
Yeah, so interest rate, real estate is really financially, it's a capital markets driven asset, right? Especially as it relates to valuations. When I got into SFR investing a decade plus ago, what really attracted me to it was the lower impact of the financial markets would have on the demand for people to actually be living in homes, right? Outside of food and water, shelters, humans, and with all the population growth and Gen Z, Gen X, all of that, you can't fight population growth that's happening in the United States. And so we felt like there's always going to be a demand for housing. And I think what we're seeing in, for a lot of the audience and a lot of the industry, especially as I've become an elder statesman now, is interest rates at a much higher rate than a lot of people have experienced before. But historically, it's not that out of the, it's not that wacky. 7% mortgage rates is not that crazy if you're my age. Although it's a lot higher than I'd like them to be as a real estate. And so, there's no question when you have a 500-point swing in a year that valuations are going to be impacted. And that's what we're seeing. As Will pointed out, though, in his presentation, demand has stayed strong. And so rents have stayed strong, demand, occupancy levels have all stayed strong. And those are and continue to be sort of the driving, demands of this sector, be it scattered site or BTR or multifamily or, whichever residential category you want to pick. I think SFR and BTR are proving to be much more stable than, the more experienced multifamily product type. And so, capital markets have a negative impact on value, but they're having a positive impact on demand because it's placing people that would otherwise be thinking about buying a home, but maybe they're on the fence. They're now firmly entrenched in for rent space because that cost, even though that home is cheaper, that affordability has gone up on them.
Yeah, I mean, I know, personally, and Beth and Will, I'd love, to get your take on this. I'm if you would have asked me what my crystal ball would have looked like 12 months ago, I certainly would have thought the rate hikes would have affected the housing market differently than it has from a valuation perspective. Beth, what are your thoughts on where we're at today compared to where you thought we might have been at, say 9 months ago?
Yeah, I think I would have to echo some of what Jeff was saying, and what I'm seeing in our clients is that the operating businesses are actually performing incredibly well because the rents are stable to increasing. People are not moving. I mean, one of the largest expenses if you're operating one of these portfolios is on the turn. There just aren't that many turns because there isn't someplace better to go. And I think, like Will alluded to, such a high percentage of this market is not the tippy top institutional player. And so they're really not even pushing rents, and people just aren't moving. People aren't moving out of their primary homes if they own it because of the mortgage handcuffs, and people aren't moving out of the rentals either just because there isn't any other supply that's going to be better, which is not necessarily the case in the multifamily market, which is why I think you're seeing that diverge a little bit right now from what's happening even in the BTR space, which is, as Will pointed out, much closer to the valuation, at least on the multifamily side. But I don't think people are moving out at anywhere near the same rate. Time will tell, because the whole notion of the build to rent market being a market has only accelerated fairly recently. We don't have enough years data to really understand it as well as we want to. It's been around forever, but not to the extent that we're seeing it right now. But I'm actually quite bullish on it right now because I think most of the stuff that's coming online is probably hitting at the right time. Also, like Jeff said, look, rates are not historically out of whack. What's out of whack right this minute, I think from a financing perspective, is volatility. We haven't seen, people are still building in a large uncertainty premium. But the actual rates aren't that bad. The stuff that we're seeing that's refis from 5 years ago actually has much better rents, much better NOI, and not really dissimilar rates. Spreads were much wider when we all started in this market. Spreads had tightened in so much that, it's a combination of base rates and spreads, but because spreads had tightened so much, them widening when the base rate's going up, it hasn't actually had as dramatic a net value number change. But right now, and I think, we were just talking about this a little bit before the call, given the minutes that just came out on the last meeting, there's still too much volatility in this market. I think we're going to see a lot more stabilization, like we've seen. I think we'll use the term stabilization for rents or normalization for rents. I'd like to see that. I'd like to see that start to happen in financing as well. And I think we're still a notch from that because of the uncertainty premium around how fast and how much rates are going to continue to go up before maybe they start coming down. Yeah.
The uncertainty is really, I think, the biggest crux of all decision making today. Will, I'd like to get your thoughts on cap rates and where things are trading from your data perspective, and then I'd like to tail off that with you, Jeff, and get some real world as an investor, how you're thinking about cap rates and how Pintar is acquiring deals, and what you're trying to achieve on cap rates. And then we'll go into Beth on how lenders are looking at returns and financing deals and where those those NOIs need to be to cover debt service. So Will, what are you seeing in cap rates today?
Yeah, so I'll caveat this with, we are just wrapping up our survey of industry participants. We send out to like Jeff and lenders like Beth, and we try and get their take on where they see all underwriting criteria. And we're just finishing that up. But I'll go backwards just a little bit to tell you where it was and then where we're seeing cap rates now. So a year ago, we did our survey. Cap rates were about 4.5 to 5%. That's a year ago. Fast forward to today, they're naturally going to go up because there's been some changes in the market, we know. We're seeing closer to 5.5, 6%. I did talk to some people about a month ago, and they were saying that all of their investors wanted to see a 6+. So they just, so that is the challenge of.
And are you referring specifically to build for rent, like new construction homes?
Yeah, that is, yeah, good clarification. That was specifically for build for rent. And then we're also seeing the SFR market, I mean, naturally is going to gravitate in the same direction. So the trend's going to move the same way, but everything has ticked up. I mean, just that's the way it is. But there is and Jeff can probably speak to this more, is, what reality might be and what your investors might want might be a little bit of a disconnect. So there's always that bring them back together at a point where you can make the deal work. But yeah, we're hearing a lot of, I want to see 6+.
Yeah, and I can reiterate that from what we're seeing. Jeff, talk to us a little bit about, how, in the markets that you guys are in, and I know you're in a lot, where are you trying to strike on scattered home portfolio deals, and what are you seeing trade, whether it's you as a buyer or, maybe some of your competitors that, picked up a deal in the scattered home portfolio, and then contrast that with, what you're doing in build for rent.
Yeah, certainly. It's really a dichotomy back to the interest rates, right? And the cost of capital. We've been fortunate to have a capital partner in the scattered site over the last 2 years. It's all cash and is less concerned about the cost of capital. That said, we haven't been out making deals because you got to look at opportunity cost. And I mean, we've been picking up deals here and there, one here, one there, but nothing of significance on the portfolio side. And the reason for that is there's been a feeling, and I think this is not just us, but the industry over the last about last year, is the future value of homes are going to be less than the present value. Now, I think that window's changing quickly. And where that yield has gone in the last year of the expectations from the industry, and it'll be interesting to see what the final strike price is on Starwood's portfolio that they're selling, which they bought at a 3, and rumor is it's going out at a 5+. That's a massive swing. And so when we hear from investors, I'd like to see a 6, that really means a 7. Right? Because the opportunity cost of that capital can get a 5 just sitting in cash. And so you need to have a decent spread between that and, a real estate investment that's operationally intensive, that does have some market risk, that does have some volatility, things of that nature, not even to mention any development type risk. So we're in the market right now raising equity. We're on a $300 million equity raise for our BTR portfolio. And these assets are in a variety of stages, from stabilized to under construction to entitlement. And for the most part, capital, there's a lot of capital that likes the value add opportunity, likes the development, the opportunistic side. And we're getting a lot of interest in that 6+% return on cost sort of metric. If you're a merchant build, there's a couple of projects that are still trading. We've heard of and seen in markets like Austin and California and Charlotte, parts of Florida, they're still sub-5 cap rates. And so those are fewer and farther between than what we saw previously. But it just comes back down to the fundamentals of real estate now, right? It's the location, it's the tenant background, it's the operations, it's, standing the test of time up against competitive natures.
Are you seeing stabilized build for rent deals trade sub-5 today, or that's where asking prices are at?
We're seeing, and I can point to a couple of deals, ground up development projects in the mid-5s return on cost projected. And the exit cap rates are being tied to current trades sub-5. So about 100 basis point spread between the return on cost and what they're projecting on exit cap rates. So look, that's few and far between, right? And it's unique buyers. It's separate managed accounts that have needs that are looking to get increased exposure to U.S. residential real estate that is very unique. The programmatic type of capital isn't out acquiring. The core funds aren't out acquiring, sub-5 cap rate deals anymore. And so, you're still able to get deals core stabilized at arguably big. And so I think you have some buckets of capital that are still very interested and are talking themselves into those types of yield returns because maybe they're looking at a 10, 15 year or maybe a legacy type of assets. But the merchant build, for the most part, what we're seeing and getting feedback on our current portfolio is you got to be in the 6s to even get it interesting.
I agree. Everything that we hear from, the Wall Street equity groups, at least on build for rent is really a 6.25 on untrended yield. Beth, from your perspective, working in both the scattered site portfolio space and build for rent and more with an eye on financing, we see such high interest rate quotes, 8.5%, 9%. There's no shortage of buyers looking at portfolios right now, but what are you seeing when you're working with a borrower, or a client that's looking to refi on a scattered home portfolio? What are the troubles, given where the rates are at today, and how are you kind of working them through, what they need to do to maybe refi or potentially sell so you can put a loan on it for a new borrower?
Yeah, look, 6 is definitely the new 5, across the board, right? Like almost unanimously, right? And in some markets, even a little more than that, right? Particularly in some markets in the scattered site, although those do tend to be yieldier markets. And so they can probably handle it. And like I said, on the refis, what's interesting to me is that the actual net rate isn't that dramatically different. And because the NOIs have been improving, people are not yet stuck if they're doing a 5-year refi. They will be soon though, right? Any of the more recent vintages are gonna have a real problem because of where they priced. And I think people know they're sitting on that. And so they are regenerating portfolios. The activity level is actually pretty high given where the rates are. Also because I think people understand that if they don't lock something now, in the short term, at least short to medium term, is probably getting a little bit worse. Although nobody wants, the way these loans work, I'm sure you realize that there's a lot of yield maintenance or sometimes step down prepay. People are not looking necessarily right now to lock themselves into these 5 and 10 years because they do think rates may come down. And so there's, again, this uncertainty concept is causing people to wait on the sidelines a little bit, pick up maybe bridge loans instead of the permanent financing that would be more attractive. And so you're seeing a bit of a surge in the more flexible bridge loan market. But as you know, the yield curve is inverted. So that's really expensive. Then they're looking at a much lower LTV. And I think that's kind of part of what's going on here is that people who need financing and see financing as accretive are finding that the lower LTV loans are probably more accretive to them than the higher LTV. Yeah. It used to be about getting as much as you could on the return on equity. I think people are realizing you have to have return. There was a great story that one of the PE guys told about their junior people at IMM saying that this guy came to him after working on the model for a day and a half saying the model's broken. He keeps putting leverage on it and it's giving a negative return. I know, all of us with a little gray hair find that hilarious because obviously you can have negative leverage. We have seen it before, and it's about getting to a point where you understand what is the right amount of leverage and also what is the right coupon, right? It's not all about levering every penny so that you can see what your return is because the model actually might be broken.
Yeah. Yeah, I mean, from our brokerage perspective, we have, what I think are a lot of good deals for buyers, but the buyers, kind of to Jeff's point, they need to have a lot more cash at their disposal, because, especially with the mom and pops, as Will mentioned, they're not as good at pushing rents, and the lenders aren't looking at pro formas today. So there might be $400 or $500 of value add in rents, on a 6.5 cap deal for B class scattered home site, which 12 months ago would have sold, like that. But if they don't have the cash, to get up to that 40 or 50% leverage, it's very hard for the lenders to help them pencil the deal, because they're not looking at the upside anymore on the rents. It's just, where is the NOI today?
Yeah, although I would add to that, for that group of people, they tend to have actually a much lower basis. And even though we in this market are always going to mark people to market on the date that you do a loan, or you're going to get a valuation and you're saying this property is worth X, they may have owned it for 10 years. Like, a lot of the players in that level of the market they're looking at it as their own yield, not a mark to market yield the way that the industry thinks about it. And so sometimes it really does still pencil for them. It depends on what they think they're making off of that property.
Yeah. So let's think about, moving forward into, the latter half of this year and going into next year. Where do you, and Will, we'll start with you. Where do you see cap rates and interest rates going, and how do you expect, what do you, with home prices, where are they going to go? And I know we were all kind of chatting about this before the webinar started, and it hard to say what the Fed's going to do, but what are you guys looking at from, a 12-month projection on home values, rates rising or falling? Where will cap rates go, which are obviously all dependent on the previous two.
Sure. And I think Jeff touched on it earlier, is, those interest rates are relative to probably when you were, in your 20s and 30s. So, back then when I was younger, I was thinking, I bought a home, I think my first home 29 years ago. And when I bought that, I thought that was the normal interest rate. And then now, all of a sudden, a year or two ago, we're getting in the 2s. And there's a big portion of people that think that that's normal, because that's when they kind of live through that first purchase. But a 7 isn't really that bad.
Yeah. I mean, their parents were paying what, 16%, 18% in the 80s?
Yeah. So I just want to reiterate that, because I think it's really interesting how the dynamics work. The interest rates, Jeff, or Michael, you were asking where we think it's going. We have where we think it might be. We don't put a formal forecast out there, but they're rising. We think the Feds are going to keep pushing it. A year ago, we thought it would be stopped by now. We didn't think it would hit 7. So I will take it back and look a little bit at history. And the market a year ago stalled roughly September, October. And it speaks to what Beth was saying. When people see quick changes and instability, that's when the pause really happens. So when we see little ticks up, it hasn't really stopped, the pause. We haven't seen that pause again. Because there is a sector out there that can afford to buy, can afford to move. They might be moving equity, they might be all cash, but they can afford it. And the supply has come down so much that you've almost kept, the demand and supply in balance. If we saw high supply, and like historical supply that I point out, if we saw that supply really high and the demand coming down like it did, it'd be a whole different ballgame. But because of that balance right there, we're thinking home prices will come down. Typically in the latter half of the year is when you see softening home prices. Just across the board, you don't see as high increases. And so we'll probably see that in the latter half of the year, just a little bit. 2024, maybe a little bit of give back, depending on how hard they push the rates, but we do think rates will keep going up. And rents, to really go how that's affecting the rental market, it is just keeping people in rentals longer. Now, the challenge there is expansion. If you want to expand and you're in the SFR market, it's difficult. There's not a lot of room for expansion, not a lot of houses out there to buy. 100% different than the last cycle, right? The Great Recession. I mean, it's night and day how this one's reacting as far as the economy and the challenges they're putting out there. But still, I mean, I think I opened with that is resilience. I mean, we're seeing a lot of resilience. And we're not seeing people bail out and double up. I mean, we've seen a little bit, but not where somebody's saying that's, you know, my rent's getting too high, so I'm going to double up with somebody else because it's just out of reach. They're still in those homes.
Yeah. Jeff, Beth, you know, what does your guys' nebulous ball suggest for home prices and you know, where things are going latter half of this year and next year?
I don't know. I think it's going to become even more market specific and price range specific than it ever has been. I mean, it's always been somewhat market specific, but we've seen a lot of moves that have been moving, you know, all the boats in the rising tide or the lowering tide in the recession. I think what's going to differentiate the next 12 months is how you're going to see a very different hit at different parts of the market. So I think you're going to see, and you've already started seeing some real softening in the luxury market and certain areas of the country that kind of cater to the higher value home. I think that given where some of the potential recessionary implications, I don't even want to call it a recession because I'm not sure it's going to look like the last one either, but those type of recessionary events are going to be hitting the higher value homes harder. Where I don't think you're going to see any negative impact, and I think it's actually going to continue to be positive, is in workforce housing, because the supply imbalance there is even worse than anywhere else in the country. I think a lot of us talk to the best data available, which tends to be somewhere in the middle, tends to be home builder type data, or homes that are kind of more in the $400,000 or $500,000 range, maybe $350,000 at the low end. But if you go into kind of the workforce housing, or what's building a pretty significant proportion of the single family rental market, you've got household formation in that cohort that has nowhere to go. And unless, as Will said, people really start moving back into their parents' basements, which doesn't seem to be happening because of the wage increases at that level. Like we have this weird, the wage increases are all going to the lower end. The supply imbalance is actually the worst at the lower end. And then you have the recessionary implications at the higher end, where you may or may not have any supply of housing. I am seeing a very bifurcated housing price increase and decrease. You're going to see both in some markets, and it's going to be driven by cohort. Yeah,
I think you're right. I mean, we've already seen, and I don't think anybody would have thought it would have been so bifurcated 12 months ago. I personally would have thought the rate hikes would have affected a bit more equally, but we're not seeing that compared to the West Coast to the East Coast, where we are seeing some value decline in the West, but we haven't really seen any in the East. And I'm sure there's some submarkets in the South and Southeast, but by and large, values have been going up. Jeff, what are your thoughts on the next year?
Yeah, I think somebody used the word resilient, and that's exactly right. The consumer's proven to be a lot more resilient than anybody anticipated. And until there's, a significant increase in unemployment, we're going to continue to see a resilient consumer. The volatility is what's driving the increase in rates as much as the increase in rates. As that volatility slows down, you'll see more stability, and it's just kind of a new normal. When we talk about pricing, I think you gotta, especially with SFR, you gotta break it up between new home pricing and resale pricing. The new home pricing, and I'm not smart enough to understand all the intricacies, but if you follow the home builders, they're very confident confident we're at bottom. You know, they're ramping up again. They hit pause 9 months ago, but they're going again, right?
Yeah.
And so that tells me, and their stocks are at all-time highs. And so what that intuitively tells me is they feel very confident they can deliver homes at a cost. They can accurately predict what that cost is going to be, which I think in the last 12 months was very difficult. But they're now very confident that they can lock in cost estimates within a range, and they can get very comfortable on the market pricing based on what they're seeing every weekend in the new sell communities.
Yeah.
So I look at that and I go, okay, how am I going to place my capital? You know, these guys are very astute. They don't always get it right, but they're not always that wrong. And they're able to, show us the volume of sales still at this price point that we're at, and pick your market at pick your price point. So,
Yeah.
I think we're there. And I said it earlier, the window of rebuys is closing. Now there may be some distressed opportunities, but this is kind of the new normal and the new value. And so, we were buying stuff, as I said, a year plus ago in the 3 cap, going them to a 5. Now we're buying them in the 5s or a 6. That's a phenomenal increase of return. So, and it's the same thing on BTR. So the BTR values have probably fallen, but the yields are, on a risk adjusted basis, phenomenal compared to historical averages across
Agreed.
all residential projects.
Yeah, no, I agree. Beth, can you talk to us, because I'm sure there's some people out there, developers and builders, and some of the biggest, I think, struggles that some people are having are in the construction financing side today. Obviously, the big builders, have lines of credit that are cheaper than most can get. But what are you seeing, and how is Encore looking at helping, kind of, I guess, lack of a better way of saying it, the kind of the smaller and mid-tier developer builders looking to do a build for rent project?
Look, it's, I think, a bit of a challenge right now, just because the regional banks, who were really decent players in this market, have pulled back so much, right? But I think the capital is, again, available. It's just at a rate, and it's going to come with some guardrails that haven't been as prevalent in the space, but it's absolutely doable. And I think what's nice about it too is that the mid-level projects tend to also have kind of mid-level total numbers associated with them, so they are actually easier for some of the capital sources. So people are definitely, the capital is available for this. It's a little bit harder to find because you don't have the relationship banker. But the other thing too is that the relationship bank tended to be at lower leverage points, and so maybe you could still get you're not going to get a high leverage point in this market, but you're not going to be maybe even as low as some of the community banks were. But the rate is real. It has to pencil. And
also, Beth, are you seeing? Yeah. Sorry to interrupt. We were on a call yesterday with a major investor, and what they're sharing with us on like construction loans is it's essentially impossible to find at over a $50 million sort of request on a construction loan.
Yeah, I guess that was part of what I was saying with the smaller bite size. A lot of the things that are getting done in the market tend to be in the $20 to $30 million range, right? Where the community is not that large. Or the other thing that's happening that I don't know exactly who this is or how they've structured it, but people are phasing the properties, which is actually the way they're built anyway, right? And so maybe you could still get to that same headline number, Jeff, but think about it in every 60, 80, 100 homes versus the entire community start to finish on the same construction. It's on the same construction line, but you could have a revolver. There's revolvers in the market that are pretty well phased. So that and again, the way you would build these is you would phase them anyway in the build. and
Yeah.
hopefully start to rent them as you're still building further into the community. I think
Exactly.
those structures are definitely getting done because it's keeping the kind of maximum out on the line in the comfort zone of most of the lenders.
And those bridge loans on these tranche takedowns that you're talking about in build for rent, are you seeing those usually being, like 24 months, 36 months?
Yeah, so 18 to 24. 24 is about where they are. I would say that's the
Okay.
average. Some people are going a little bit longer, but it's hard to back lever any longer than that. You can certainly do 24 months with extension.
Yeah. And
again,
that's very
to get
doable. If you've got
extension-
150, go
Right,
ahead.
people need to understand, to get the extension, you have to actually be hitting your rents, hitting your timelines, right? Like, I mean, that's what people are looking for now in the, who are balanced getting these loans is, everyone's looking for just a little more certainty, a little more milestone, a little bit clearer. And the phasing allows everybody to get there if, particularly if you're hitting your numbers.
Yeah. Well, and I didn't, curious if you can share some numbers, and this question you weren't expecting, but, talking about construction, obviously cost was a huge issue in COVID. You don't have to go too detailed, but in general on construction costs today, what are we seeing nationally? I understand a lot of costs have been coming down. I've heard site work is still up there, but what are we seeing in general on costs, and where do you think they're going?
Yeah, we're constantly having those conversations with builders.
Yeah.
So it's I would say they're more pleasant conversations today than we were hearing, probably a year, 2 years, 3 years ago. I mean, it's not a surprise. COVID really hit the supply chain and made it difficult. Right now, we're hearing, just had a call yesterday with someone, and their costs were down about 10 to 15,000 a unit, which is a huge decrease. So what they're doing is they're looking at that against where their home prices have come down. Maybe they'd given some concessions away or something, and so it's making their pro formas a little better than they were, last year. I would say the supply chain issue, or I would say materials and labor, there are still issues. We're not over that completely, but I think someone on here said lumber's down. Lumber's come down. A lot of the line items have come down, and to see decreases has put a lot of positivity in people's minds of, I know I keep saying stable, but stable construction costs are a huge deal. It's something that doesn't give that volatility of, I don't know what I'm going to get next month. So that's a very positive thing. The builders are still, and this is market specific, just like Beth had said with other things, it's market specific. Labor is market specific. We have some areas that labor is really tight, so they're still pushing those builders for higher wages. Materials, there are some line items that are tough to get, so there's still some delays out there.
Yeah, I was going to ask, Will, specifically to that point.
What's that?
We have clients that cannot get transformers. So.
Yeah,
you know what's funny? I was just about to say that. I'm like, transformers is one we keep hearing, and they just can't get them. So you're talking, you can't get a C of O, you can't finish the house, you are delayed. And those few, it only takes one item, right? It only takes one item that you can't get that's very specific that you need to delay that house. But with that said, I will say that the timing of construction from start to finish has become more normal. They are getting within a date that they can project, and they're going, okay, I know it's within this band, rather than, I thought it was going to be 6 months, and now it's 9 months later, and now it's 10 months later, and now it's a year. So, and that's what the market needs from a home buyer perspective too, right? I mean, a new home buyer doesn't want to sit there saying, I don't know when I'm going to get my house, and we have moving interest rates. So it adds some some credibility to home builders to be able to tell a buyer, I'm going to get your house done in 6 months or 5 months or 9 months.
Are there, and it's interesting, Beth, I'm glad you mentioned the transformers because we've been dealing with that and hearing about it as well. Will, are there any other materials that are, they're still trying to catch up from the kind of supply clog that happened? And, what are there a couple specific that are still delaying some of the building, and do you see that clearing up, in the next 12 months? Where do you see the materials shaking out?
Yeah. And we have a building products materials team.
Yeah.
I'm not on that, so I don't want to stick my foot in my mouth too much on that one. But it's funny because that transformer thing, I just heard yesterday, the issue in Southern California. And it feels like there might be one transformer company that's across the country, because you'll hear it in the other side of the country as well, which is
It's so interesting because I've been hearing it mostly in Florida, and I thought it was really hurricane related because of the rebuild, right? I mean, and you can't.
Texas too.
Well, there you go. The transformer is the thing.
Yeah. But there will be things that pop up, but it's very different. When you say 12 months, Michael, I think of where we were 12 months ago and how much it's changed to today. So, a year from now might be, hey, we've resolved all the issues, and, you're just dealing with, somebody didn't order it soon enough, not necessarily it's not available. So, I'm hoping it's a world of difference. And what we're also seeing is we're seeing sales rates of new homes become more stabilized. And I think that sales rate is becoming more stabilized because of materials is becoming more stable. So you don't want to sell a home that you don't know when you're going to close. So you're starting to see, rather than these kind of roller coaster rides of sales rates, you're seeing more, every month we're kind of selling the same amount of homes because we know we can build them.
Sure. I know everyone here, and we've only got 2 minutes, try to wrap it up real quickly with some last comments from everybody. I think everyone on this call is a believer that the SFR build for rent market is insulated compared to other commercial real estate asset classes for the most part. Are you guys, general recession question, but do you think we are going to have some type of housing price correction, or will there be a housing recession in the next 12 months?
So here's what I think. I don't think it's insulated, but I think that the positives and negatives are balancing to a pretty stable housing market. If you take into account my earlier comments about different parts of it, I think the biggest risk to my view that housing stays stable to actually increasing in the lower ranges is household formation. The household formation numbers have to hit not 100% of what people are projecting, but probably 70 to 80. That to me is the only real risk here, is if the household formation numbers don't actually hit the projections, which I do think they will. I don't think people move back into basements in such an alarming speed that it would impact them. As long as you have the household formation and the positive and negatives of what's going on in this market, we're going to see stable to increasing value.
Jeff?
Yeah, I think it's a great question, and it's one we ask ourselves daily. And multiple times a day, continuing to test our thesis. And the last 13 years I've been doing it, I continue to come back to, I think this is the best risk-adjusted investment strategy there is, especially for the long run. And it's basically the mantra of our company, protect, preserve, and grow your capital. It's proven in the worst of times is residential for rent investments have delivered a consistent, predictable stream of revenue, while the values may fluctuate. I think values on SFR are stabilized. I think BTR and multifamily, you may still see some continued price compression just because the cap rates are resetting, and that has to do with the capital markets side of it. But you're getting outsized yield return. And so my view, and I'm not Will, and I don't have all of his data, but we feel this is still the best place to be putting your money if you've got long-term capital appreciation and consistent yield sort of expectations
Yep.
on your capital.
Yeah, well, I 100% agree. And Will, you've kind of shared some of the thoughts on that question anyways, and we are out of time. So Beth, Jeff, Will, I want to thank you all for participating, and hope everybody that was listening enjoyed the conversation. I didn't see any questions come in our Q&A, so I just kept the discussion going, but want to thank everybody for joining, and big thanks to Beth and Jeff and Will, and Beth, congratulations on your new company, Encore. Best of luck. A lot of work to do out there.
Yeah.
And
thank you. Thank you very much, Michael. Great job, Beth. Great job, Will.
Thank you so much for hosting, Michael.
Yeah, thank you.